Welcome back to the Foxy Accounting Minutes. This is our second episode, and we have a fun game for you this time. We're going to play a quiz, Are You Smarter Than an Accountant? We're playing a game of myth versus facts for small business finances. Let's see how much you know. First question, myth versus fact. You don't need to keep receipts for expenses under $75. It's a fact. You don't need to do that. But in general, you're going to want to keep receipts. There are several ways to do this that don't require you actually keeping hand receipts. There are many apps that can make it so that you can just take a picture with your phone. We can make keeping receipts easy and not have all the paper. Question number 2. If your business loses money, you don't have to file a return. It's in your benefit to file a return because that loss will transfer over to the next year, and you'll be able to take it in a year where you are more profitable. So you won't have to pay as much taxes on that income. Question number 3. Mixing personal and business expenses is good as long as you keep good notes. This is a big myth. Mixing your personal and business can be a risk because it can make you forego the protection that you have by creating your business in the first place. You created your business so that your business and you would be separate. If you mix all of those together, you can sometimes be held personally liable for things that your business does. It's also just a bad practice. When you mix these things up, it makes it harder to sift through. It makes it harder to have clean books, and it makes it harder to make decisions. Question number 4. You can write off 100% of meals if they are business related. This is a myth. For the most part, you can only write off about 50% of your meals and entertainment for your business. There are some exceptions if it's directly related to your employees, like a company party or the benefit of providing lunch. But you want to be cautious because that can pull up red flags when you go to do your tax returns. Question 5. Paying yourself as an owner means that you can skip payroll taxes. This is a myth, partly because it depends on your entity. So if you're just a regular LLC, yes, you can get away with not paying payroll taxes. But still, once you get a certain amount of employees, you're still going to pay for it in other ways. If you're an S Corp, you're required to pay yourself a reasonable salary so that you can gain all the benefits of being an S Corp. So you will definitely have to pay your payroll taxes. Number 6, hiring your kids can save you money on taxes. This is a fact. Yes, you can save money on taxes, but it has to be properly structured and they have to do actual work. If you get audited, they're gonna wanna ask what kind of work were they doing, what hours they spent. So you're gonna wanna make sure that you have a little bit of backup for that. But yes, you can save some money on taxes. Number 7, all business debt is bad. This is a myth. And like anything else, all debt is not created equal. Most companies are not going to have the liquid cash to be able to pay for equipment, trucks, inventory. So a certain amount of debt will need to be incurred. The difference is planning it out and being strategic with it, only using the amount that you need and making sure that you get the best benefit out of it. Another good thing to do is to strategize about your debt. Planning out how you're going to pay back the debt can also be a good strategy. That way you can make sure that you're paying the lowest amount in interest and you're getting out of debt as quickly as you possibly can. Question 8. Bookkeeping and accounting are the same thing. This is a myth. Bookkeeping is just recording your day-to-day transactions, your invoices, your bills. That's what bookkeeping is. Accounting is the strategy and analysis that you come up with after those books are completed. The difference being is one is just recording and the other one is looking in depth to this to make it so that business owners can make better decisions. And we have one last challenge, and this one's a tricky one. You can deduct your pet as a business expense if it guards your home. I know a bunch of you must be laughing about that, and I'm sure a lot of you could probably make a pretty good argument for it, but this is a myth. Unless it's directly related to the business that you're in, it's not deductible. And remember, with a lot of these deductions, you want to keep in mind that for the most part, you're the one signing the tax return and you're responsible. So when the IRS comes knocking, you're the one that's going to have to explain it. Okay, so how did you score? Did you learn something today? Looking through these questions, these are not normal things that you would think about unless you're pretty much an accountant. It is incredibly important for you to understand your numbers and to make sure that you're taking your proper deductions for your tax, that you're classifying things correctly. And a lot of this knowledge is not going to be something that you would know. All right, how did you score? If you nailed every question, maybe we're hiring. If you missed a few, don't worry. Most people are going to. That's why we have accountants. So I hope you had fun today on the Foxy Accounting. Thank you for playing along with us on our Foxy Accounting Minutes today. If you had fun, please subscribe, comment, and give us a big thumbs up. Until next time, I'm LaDonna Garvin with Garvin Accounting Solutions.